Okay. Deanna, welcome back.
Thanks. It's good to be here.
I think last time me was, and you were somewhere else. I don't know, where were you? Oh, it doesn't really matter.
It's been a bit of travel.
Been a bit of travel. But anyway, lots of stuff's happened since then. The war, I think it started the last time we did the podcast. And it was early days though, so the oil price had only gone up $10, $15 a barrel or something like that. Now we're seeing a situation where oil prices have gone around $100. Interestingly, for the last couple of weeks, they've sort of been bouncing around that level, depending on what Trump says. But we've seen petrol prices in Australia sort of pushing up around $2.50 or even more if you're in regional areas. So not a great situation.
So what's happened compared to where we were a few weeks ago? The last time we did the podcast has been a few weeks. I mean, the biggest change has been that the supply of oil has really been hit due to the war. In the early days, we weren't sure if the Strait of Hormuz, which is a critical choke point for oil tankers in the world, which is basically controlled by Iran, we weren't sure if that was going to be shut off, but it has been now, and Iran is controlling that area. So they're not letting many, if at all, oil tankers and other ships through.
Apparently a few have gone through.
Only the friendlies, so countries like China or Japan or India. And that's why we've seen this big reaction to oil prices. And that's why there's a lot of concern that we could be headed down the path of stagflation around the world.
Well, that's a term from the 1970s when prices went up and economic activity was depressed and unemployment was high at the same time. So you had stagnation, if you like, economic stagnation and inflation simultaneously, partly in response to supply responses associated with the two oil shocks, 1973 and 1979. I mean, the thing that worries me about this one is that the Strait of Hormuz, and we hear this one often, 20% of oil and gas flow through the Strait of Hormuz. That's global consumption of oil and gas go through the Strait. And the oil shock of 1979 was 5% of supply impacted. This time around, potentially as high as 20%.
So how come the oil price hasn't gone up more? Like, you'd think that if we've never seen the Strait closed before, this is, some people are saying, the biggest oil supply shock that we've ever had. Why aren't prices more like $150 a barrel or $200 a barrel?
Well, that's the thing that surprises me. And the IEA, International Energy Agency, are always saying, this is the biggest shock on record, far bigger than the ones in the 70s. And back in the 70s, in 73, the oil price went up fourfold. And in 79, it went up threefold.
So now it's about twofold.
Yeah, now it's about twofold. If you sort of go from the start of the year, West Texas, I think at one point there was 55. We've gone to around 100. Brent is always a bit higher and probably a little bit more of an increase, but it's about 100% if you go to the high points, which you could argue is, well, it's not much of a rise if they went up three or fourfold back then with bigger shocks. But you could also make an argument that we've all been trained as investors, as oil traders, whatever, to the way Donald Trump reacts, that he goes in hard, that he has back down. So he announced the huge tariffs on Liberation Day and in the aftermath, and then he has a back down, usually after there's some sort of share market or bond market rebellion of some sort. Similar story in relation to the Fed when he was talking about all those actions to reduce Fed independence, and then that he backs down. Maybe he did the same in Minneapolis with ICE, back down when it got, obviously it turned horrible over there with people dying. But so maybe he's going to do the same thing again. I kind of think that's what's happening. And he's shown on several occasions that he wants to do a taco. That whenever the oil price spiked, like it did a few weeks back, got to almost $120 a barrel. That's West Texas. He then immediately came out before the US markets opened and said it will be over very soon.
But he's full of inconsistencies because he says the US doesn't even use the Strait of Hormuz, but then why are their gas prices going up? I mean, their gas prices are like about $3 a gallon, according to some figures, and they've gone up just as much as Australian petrol prices. But then the next day
percentage-wise, I think they would have gone up by more. And we're protected, if you call it that, by the huge component, which is the fuel excise. So our petrol prices are always higher. So if you've got a given increase in the raw ingredient, then it impacts the US petrol price more than it does the Australian petrol price, percentage-wise. But still.
And then the next day he says, when this is all over and we're negotiating, oil price is going to drop like a rock. Yeah. So which one is it? I find it, I mean, I guess this is part of, what they say, the fog of war is like that you don't really know what to make of the announcements that are coming out. You sort of see different announcements coming out from Iran and then from the US as well. You don't know how the negotiations are progressing, whether there are any negotiations at all. So I think the best we can do is sort of try and figure out what the probability of different scenarios are, and also to keep track of if there's any shipping that's going through the strait, what the number of attacks are between the different countries, so between Iran and Israel or between the US.
We've been looking at those things. We have charts of ships going through the strait, and there has been reports of a couple more going through recently, and the reports did seem to die down on Sunday, I think it was, or Monday maybe. Then we've seen them pick up again on several occasions. So, I get what you mean in terms of, he says one thing, that it's another thing. Like on Friday, Saturday morning when I got up, US shares were down heavily, oil was up heavily, and that was partly on the back of Trump not ruling out the use of troops and talking about saying that it's too early to de-escalate or to have a ceasefire. And then after seeing the market reaction, he suddenly comes out and says, well, he's considering winding down the military operation, which then gets people relaxed. And then a day later on the Saturday, he's saying to Iran, unless you reopen the Strait of Hormuz within 48 hours, I'm going to start destroying your power stations. And Blind Freddy could tell you, if you do that, they're going to send missiles at energy infrastructure across the region. And of course, they then realise that, then he does another back down. So lots of contradictions here. I guess the problem I have is that I think he is getting kind of desperate. I seriously think that he thought that this would be a bit like Venezuela. And he had been musing about that they would go in there, the top guy would be wiped out and they'd put someone in who's more friendly towards the US. They'd reorientate. So it wasn't regime change, it was regime recalibration or something. So it'd be recalibrated to the US, which you could argue was wishful thinking. I think most people would say that that's wishful thinking, and quite clearly it hasn't turned out that way. But then by the same token, you had a chart the other day, his poll support, I think, is down at around record lows, his approval rating, whereas Trump 1 was starting to see a pickup at this point.
Leading up into the midterms.
Midterms back in 2018. And you've got the issues with inflation in the US. Most Americans say they're worried about affordability and inflation. They're not worried about foreign affairs. And you've also got share markets, which they do sort of get twitchy whenever there's big falls in share markets. So you can make an argument, given that we are so close to the midterms, that he is under a lot of pressure here.
Well, that's a huge constraint, I think, on the war being able to continue for too much longer, because affordability is the number one issue for voters. I mean, unless there's sort of, it becomes inevitable that the war's going to cause a global recession, in which case maybe he'll just think, oh, well, let's just try and destroy the Iranian regime. Maybe that's sort of the worst case scenario from here. But
if it goes too far.
And
America's heading to a recession anyway, and he's going to get wiped out in the midterms, and he thinks, well, what have I got to lose? I might as well wipe them out.
Yeah, that's probably the worst case outcome from here. But I think the constraints around Trump are still there, and on Iran too, because China may pressure Iran to sort of allow the strait to reopen. As much as China has its own reserves of oil, probably more than a lot of other countries, and it's hugely electrified now with all their renewables, they still, it's not just oil that flows through the strait, it's also fertilizers and chemicals and other products that the rest of the world uses. So I think
including
China may pressure Iran.
Including the US. Despite Trump saying the US doesn't use the Strait of Hormuz, they actually do get a lot of stuff from that region, including raw material for fertilizers. And part of the problem also is that most American oil refineries are set up for heavy crude, not the light sweet crude that comes out of the US. And so that's why arguably they're interested in oil coming out of Venezuela, because it's the sort of stuff they want for their refineries.
And then you have to think about the secondary impacts from this. It's not just oil, but then obviously companies are going to pass or could pass through higher oil prices into other parts of the supply chain. In particular, food prices, I think, are a risk, higher food inflation. So, it's probably another few months until we see the impact to inflation really play out. I mean, we've upgraded our inflation forecasts quite significantly for the March and the June quarters, but it could be up until September until we see the full impact of this.
So let's say there are talks between Iran and the US. I know Iran's denied it, but maybe they would do that anyway. Let's suppose there are talks. I mean, Trump seems to be saying there are, and they've released a 15-point plan. I think it was 15, it could be 16, whatever it is. And they want to make a deal. I don't really like that term because he used it in relation to China, and the evidence suggests that the US wanted to make the deal with China, not the other way around. China didn't actually.
But apparently to him, everyone wants to make a deal with him.
Yeah, maybe they do, or maybe they don't. But let's suppose we get in the optimistic path, and to some degree, this is our base case. Well, the base case, I've sort of thought that this would be a relatively short conflict, measured in weeks, not months and months. And suppose Trump is at the end of his tether, he's lost patience, he wants to end the war now, hasn't turned out the way he wanted. Let's find an off-ramp, so to speak. So let's say in the next week they do manage to sort of come to an agreement with Iran, and Iran at least frees up the Strait of Hormuz. And then you can see a situation where investment markets did pretty much what they did with Ukraine. It had a huge impact in 2022, and then a little while later, it's still going, but it has no impact on markets. Or like the terror attacks back in the 2000s, which were a big thing at the time. But then as each terror attack occurred, markets seemed to sort of focus less and less on it. It became like background noise to some degree.
But I suppose the problem with something like Russia-Ukraine was that it still had a huge impact to commodity prices for a lot of 2022. And then it led to, a flow through into other parts of the economy. And it was one of the reasons that we had such elevated inflation.
Oh, it's certainly one of the reasons. But here we are 4 years later, the war is still going, but we don't talk about it anymore.
Yeah, but maybe inflation would have been lower without it.
It could have, but most countries got back to around 2 or 3.
Except for us.
We did briefly. We were around 2.5 momentarily. And I think most the factors in Australia were Australian related. I don't want to go down the obsession of government spending again, but it is a factor. I don't think Ukraine's had a big impact on us. You sort of wonder whether you can get to a situation where the war continues, but if Iran's decided to reopen the Strait of Hormuz, even with a fee of $2 million a ship or something, then markets sort of think, oh, well, okay, it's still going on, but we're still getting the oil and we can survive. Albeit it'd still be a bit more expensive than it was before.
Yeah, well, that's going to be the key from here. And speaking of inflation, we had the February monthly Australian data. I mean, who really cares?
Because I would have got real excited. What was it? What was the trim mean?
Trim mean was 3.3% over the year to February. So that's good. It was better than, last month was actually revised down.
It, yeah.
But headline still too high, 3.7%. I mean, some of the components looked okay, but rents is still too high. You had a
beautiful chart there. There was one big, beautiful chart in there which had the percentage of items which were above 3% and below 2%, and now it's going the right way. There's less above 3% and more below 2%.
Yeah. I think it's going the right way, but it's still too high. And the problem now is that it's going to go even higher with higher petrol prices and the flow through to other parts of the economy.
So what are we forecasting for March?
So for the March quarter, we now think it will be 4.3% over the year for headline. And prior to the war, that was somewhere around in the low 3s, I guess, or the mid 3s.
Because we were kind of optimistic it had come in below levels the Reserve Bank was forecasting.
Slightly, but the January monthly data was a tad higher than we had expected. Yeah. And for the trim mean, we think it will be 3.6% over the year to March. So that's still way too high for the RBAs.
So that's allowing for a little bit of flow through from the higher petrol price.
For the trim mean, it will not really for petrol. Maybe there'll be a little bit of flow through from other parts because we know that transport companies have already been hiking up their prices. I mean, petrol will be trimmed out just because I think it will be such a large increase.
Yeah. I mean, you also got this complication that when the CPI numbers for March break, the media will focus on the monthly number, which will probably be 5.1% or something.
Yeah.
Whereas the quarterly number, you could argue that's probably what the Reserve Bank wants to focus on, but it'd be hard to ignore the 5.1% number out there because it will affect inflation expectations. and wage claims and so on.
And we can already see that inflation expectations have been rising, and this was, they were taken around the middle of March. So I think with petrol staying at $2.45, which is at the moment, it could go even higher than that, inflation expectations is going to keep being really high.
Yeah.
So that's why I think it takes a bit longer to play out. And we've now got an expectation that the Reserve Bank increases rates again in May.
But that's based on a reading of how we think they will see it, which is inflation is too high and this will all add to inflation expectations.
Yeah.
And run a risk that we end up back in the 1970s.
Yeah. And also what I call the PTSD from COVID and the supply issues then. Like, yes, it's a supply shock. Normally,
what's PTSD? Post-traumatic
stress disorder.
Because you think I've got TDS. Trump
derangement syndrome.
Trump derangement syndrome, yeah.
You do?
How do you know?
Because
I thought I had OCD.
Everything he does is negative according to you.
No. He does do some good things. Yeah. From an economic point of view, I guess I'm back there in the 70s or the 80s, and I kind of liked leaders like Hawke and Keating and Thatcher and Reagan because of their free market policies. And I liked it in Australia because we had a good focus on free market deregulation, opening up, what we called economic rationalism. But at the same time, we had a good focus on social safety net, Medicare, superannuation, minimum wages. So I thought we got the balance right in Australia, whereas I think Trump he's not Reagan, but he's not Hawke and Keating. It's sort of like he's just Trump.
This is another history lesson.
Another history lesson, yeah. So I find myself I can sort of relate to, like I love Milton Friedman because of the clarity of the way he looks at things. I think sometimes he likes a bit of compassion and what have you, but I love his consistency. And that sort of inspired Reagan to some degree, whereas when you look at what we now have in the US, it's contrary to that. It's a lot more complicated and confusing and populist and messy.
But it's like that in a lot of countries at the moment.
True.
It's like the moral hazard, that I think the population expects the government to step in more, and the central banks as well.
But then government can't do everything. This is what Reagan would show up and crack that joke and say the worst thing you can say is I'm from the government, I'm here to help, which is a bit extreme. But his approach was, too much reliance on government has actually led to a problem. And you do sort of wonder about that we are too reliant on government. Whereas in America, you've got elements of Reagan in Trump. You've got deregulation, all that sort of stuff. But on the other hand, you've got lots of intervention by government in the economy, which sort of messes things up and confuses them.
Well, we've gone down a bit of a rabbit hole now.
We certainly have. Well, I was trying to explain why I don't have TDS. I'm just worried about the economics of all of this.
Yeah.
It's like when you look at the UK, I thought Jo Masters made a good point the other day when we were in Canberra, where she said that there was a lot of doom and gloom coming around Brexit. And of course, it didn't turn out so bad. But then here we are 10 years on, and you can see the cost that it's had for that economy, that it's a bit of I wouldn't say a basket case, but it's been having a lot tougher times. And a lot of the reason for that is because of Brexit.
Yeah, but I guess in the interim, they also had poor political decisions, which weren't related to Brexit.
Yeah, but some of their politics was a result of the Brexit fallout, So anyway, you were trying to get back on point.
I was basically just going to say the situation is so in flux that it's hard to be precise with your forecasts right now.
Well, I think it is. And yeah, we had to do some recently for a survey, and I kind of think this is the worst possible time. I think there's also lessons in this for investors. And you got to remember what happened last year. If you go back a year ago, coming into Liberation Day, which I think was, April the 2nd or something like that, there was a lot of uncertainty then. Share markets were falling. The US share market fell 19% from its high in February to the low on or around or just after Liberation Day. And then we fell something like 15%. Global markets were in between. So, yeah, that was a time of extreme uncertainty. And then suddenly the fog lifts a little bit and markets picked up. And that is extremely hard this time around. You're sort of looking at this and say, well, I can't see an end to this conflict. On the other hand, you can sort of make a strong argument that Donald Trump will want it to end and Iran doesn't want to go so far that it gets totally annihilated. and there's no chance of the government surviving at all there. So, and it caused massive damage to their people. So there's some sort of middle ground there where maybe there is some sort of relief, but try to time all of that, I think, is really, really hard, just as it was a year ago in relation to Liberation Day. So the key for investors, I always think, and this sounds totally boring, the key is to sort of to stay there. If you agree that this was an appropriate long-term strategy when you went in there, or the default superannuation plan, and you've still got 20 years to go to retire, then you're better off staying where you are. Because by the time you get out, a lot of people do this. You get out and then you sleep well for a few nights, then markets make a bottom and initially you don't believe it and it goes up a little bit. It's just a dead cat bounce or something like that. And then you find it's got back to its previous highs and then you want to get in. But in the meantime, you've wiped out all that value by selling at the bottom and then only wanting to get back in when it's back at the top.
I guess some will be thinking, well, maybe it is time to start getting back in, but there's so much uncertainty that, it's hard to know whether markets can fall even more. And Australian shares have fallen by over 10% already.
But most people would still be in there, I reckon. And so I would think if they're still in there, then you're probably better off staying in there. I mean, it's true. Last year we fell 15%. We fell 16% in 2022, the inflation scare. This time around, we were on Monday, we were down 10%. And then it rallied a little bit, so we're down 9%, and now we've rallied a little bit from then. But so it could go further. You just don't know. But I tend to think you're just better off staying where you are rather than trying to time it. No one's going to ring the bell at the bottom.
Well, that's a good way to end it. So thanks, Shane, and see you next time.
Thanks, Diana. Take care.